Let's start then by just introducing the panel, which is initially really to talk about the fact that investment selection, divestment and engagement are our dial-shifting tools. And apologies for keep using that term. I'm trying to keep it in plain English, and that feels kind of plain Englishy to me. But which do we use and why and when? And will the SDR actually help make this easier for clients to understand? Now, obviously, the SDR hasn't gone live yet, so we can't be too specific. So let's focus on what clients do and don't understand of strategies generally. And you'll notice we've abandoned the lapel mics this year. We had a few issues with them last year, so I'm hoping that these mics will work fine. But just to say, everybody, don't put the mic too close to your mouth. And I probably will occasionally myself, so if you do, it's not the end of the world. Perhaps I could ask everyone to introduce themselves, please. Miranda, maybe you'd like to spend a moment, a minute or so, saying who you are and what you do, please.
I'm not sure if this is working. Is it? Cool. I'm Miranda Beacham. I'm head of ESG for Equities and Multi-Asset at Aegon Asset Management. It's a role that I have been in for 27 years, which seems a very long time. And I've seen a huge change in the marketplace from when I started. And obviously, Aegon has been in this marketplace since 1989 when they started their first ethical fund. And we've seen huge amounts of progress throughout those years, and it's actually been quite personally satisfying to see that transition and the amount of interest that it's garnered. So yeah, looking forward to this discussion.
Cool.
I'm Amy Browne, a stewardship lead at CCLA Investment Management. So my role essentially covers all of the different sustainability and stewardship themes that we focus on, which basically cover three main areas, which we describe as better health, better work, and better environment. I'd say very similarly, CCLA, she stands for charities, churches, and local authorities. So 90% of our clients are non-profit organisations, and there's been a very, very clear move over the past decade or so from primarily restrictions-based, ethical exclusions to actually how we can drive positive outcomes through our stewardship work.
Hi. Sorry. Go ahead, please.
Hi, I'm Megan. I'm a global equity and multi-asset portfolio manager at Saracen & Partners, and I look after a range of funds from those that have embedded ESG analysis and integration without any restrictions to those that are much more concerned and focused in their ethical restrictions and approach. So I'm really interested in this discussion of how we strike that balance and how we price that risk and where we think the market is on that, and the difference between engagement, which we're very active in, and divestment as well.
Hi, Adam Robbins. I work for Triodos Investment Management. I've been with Triodos for about 6.5 years now, after having a bit of an epiphany when my daughter was born. Having spent the best part of 20 years in financial services, I wanted to align my personal values with working for a company, an organisation that fitted that. Triodos has been at the forefront of sustainable and impact investing since about 1980 when it was set up, and it's kind of all that we do as an organisation. So yeah, very much looking forward to this conversation as well.
Cool. Can I ask you to start, Miranda, just a few words on, look, it was very difficult for the FCA to comment given the timing, and I as I say, I really appreciate that they did rock up and didn't say no. But do you have any initial thoughts on whether or not you think SDR and that kind of thing will be helpful? Is labelling a good thing? Will it help people to understand the strategies generally, do you think? Greater disclosure being a key part of that?
Yeah, I hope so. We've always tried to be very transparent, from the ethical fund to the sustainable fund, in really helping our clients to understand exactly what we do, the ethos of the funds. And so anything that can help us in that journey is good for us. Obviously, SFDR attempted to do that, has not managed to stay still for 6 months at a time. It keeps changing, and so it's muddying the waters. And so I'm actually quite glad that the FCA are taking their time to get the SDR regulations out in the hope that they will actually get them right and that it will make things completely clear to our underlying clients as to what kind of funds they're investing in.
Cool. That's certainly the plan. Would anyone else like to come in on that?
Is the FCA still in the room?
Before I comment.
No. I'm only joking.
Does anyone know the answer?
Actually, I think we'd be in the camp of it's landed just about in the right place. We're very supportive of the way that it's been set out up until now. I think what it allows consumers to do is to choose their theory of change and a sort of very clear framework on how it can be measured and monitored and executed over time.
I would agree with that as well. I think any degree of consistency that helps advisors and clients decide on what really is sustainable and responsible would be really welcome. I mean, I know you have a session later on the data providers and the different ways of interpreting ESG or stewardship or sustainability, whatever you want to call it. But if you look at the ratings agencies and the companies that they review, there is such a broad spectrum of where they agree and disagree on the same company that it's almost impossible for a one-size-fits-all. So anything that gives structure to that, I think, would be very useful and beneficial for the whole industry. Thank you.
At the risk of just saying yes again and agreeing with everyone, I think the labelling system is going to be really important to provide clarity for the retail investors, but I think it will also help yourselves in this room as well with how you position the funds for your clients, and that's really important. I guess the concern potentially is that you end up with a lot of funds going into one bucket or another bucket, so focus or improvers, and it could become a bit of a catch-all for some. So again, whether there needs to be a bit of differentiation in there. But I guess the flip of that is having too many labels.
So how about the improver label? You didn't mention it there, but obviously most fund managers have got stocks in there that are imperfect, because let's face it, the world's imperfect and companies are imperfect. And that's one of the things I think ratings agencies struggle with so much, is to come up with something that says, well, actually, this fund manager is actually trying to change this company. You can agree or disagree with the fact that they may or may not be able to succeed, but do you think, I mean, just having an improver label or just telling people that this fund actually focuses on trying to change things, Adam, do you think that's workable?
Yeah, I think it is actually, because again, you know, that we know there are a lot of asset managers out there that hold those companies but are not engaging necessarily in the right way.
Do you want to tell them what you disclosed to us earlier about your view of improver funds?
I thought that was Chatham House, there was no microphone. No, my concern was that there will be some funds potentially that might go into the improver bucket that are not actually doing what they say they're doing. And again, for me, a lot of this just comes back to the transparency of what we're doing as asset managers, and if you are very clear around what you invest in, what you will not invest in, and you communicate it clearly and show that to the end clients or yourselves as the intermediary, then that's a good starting place anyway.
Yeah.
But I think the improvers bucket, needs to have tangible evidence that improvement actually has been done. I think that's in the criteria in the original consultation anyway. So that gives me a degree of confidence that not everything will just be bunged into that bucket.
And clients should be able to see this when they look at a company's voting records, their asset managers' voting records, and their policy outreach as well. So that's something that I guess is already there and should already
probably
be
the intermediary on their
point.
behalf, I would argue. But
Yeah.
Most clients probably won't. But yeah, so, and I think that's right, that comes through the disclosure, doesn't it, to be able to see. And one of the things that certainly I talked about with the FCA a lot some time ago was, just having checks and balances in there, so that if someone says they're still engaging with Exxon, and we've been engaging with them for 20 years, clearly, we want them to change, and engagement will probably help, but probably it doesn't deserve the sustainable label, but who knows where it will land.
And that comes to your question of when do you stop engaging and when do you divest? And for us, it's very clear. You divest when there is imminent and material risk to your client's capital, and you don't think engagement is going to change that. And there are many shades of grey on how you determine that, but for us, that is definitely the red line, is if this risk that you're engaging on is so material that it threatens your client's capital.
And you articulate that to clients and intermediaries so they understand.
Yeah, because look, sustainable investing and responsible investing, it has definitely been caught up in this kind of culture war and pushback against wokeism, especially in the US. But if you really take it back to first principles and think about what it is trying to do, it is trying to achieve returns for clients, because that's what we're here to do at the end of the day, in a way that is sustainable in the future. Not just from a feel-good perspective, but it will be durable in how they make their money. It isn't threatened by taxes or regulation or stranded assets. It all comes back to the same thing. It's just different interpretations, in my view.
Yeah, or indeed sea level rises. Some of you have noticed the imagery that we've come up with, the level of carbon in the atmosphere now. I think was last seen, according to certainly something I read, it's millions of years ago when the sea levels were 8 metres higher than they are now. And,
Precisely.
you know, we're running into a dangerous place, hence all the sunk imagery that I've gone for on this. And, you know, things were very, very different then, and clearly we'd struggle. So, yeah, excluding assets then, or maybe for the both of you, excluding assets then, when you kind of say, game over, this isn't really working. Well, maybe Amy, you'd like to pick up on that. Where do you go there?
I think exclusion comes into two buckets for us. There are values-based exclusions or beliefs-based exclusions, which is where our clients, we'd like to help to protect their reputation, to avoid, you know, investing in something that's going to jeopardize their, you know, or conflict with their social obligations, their beliefs, their values. So that's one type of exclusions. And then there is the type of exclusions, as in divestment, where you believe, or we believe, that engagement with a company that either will not or cannot change is just a waste of time. And so one example would be a couple of years ago, we sold out as a firm, not just at fund level, but as a firm entirely, the oil and gas sector. And that is something we will not go back on.
Yeah, that makes sense, because let's face it, the engagement hasn't exactly landed terribly well just yet.
But engagement can also help you with, so we talked briefly about the limitations of the third-party data, and we see this in particular in the medical technology sector. One of the big indicators for the ESG rating there is obviously product recall and patient safety. But comparing two medical technology companies, you really have to look under the bonnet, because if you have a product which is innovative and at the cutting edge of the solution for a patient, it's much more likely to have a product recall. So if you engage with a company and you understand that data, it can really help you, find the best opportunities, but understand the limitations of the data as well. And engagement is a really useful platform to understand a company, its culture, what it's trying to achieve. It's a door opener that is both a positive and constructive way. You're not just grilling the company on their return on invested capital objectives. It's something that allows companies to showcase who they are. And we find management are very responsive to having engagements on things that are not just standard, financial metrics.
You're actually interested in their business and what
exactly,
it is they're doing.
Because ultimately that is who you are trusting to make money for your clients. It's the management team. The business is the people at the end of the day. Sure, they'll have fixed assets, the factories, etc. But ultimately it's the people that make the difference to the returns.
Absolutely. Miranda, can I bring you in on this?
Yeah, no, I'd absolutely agree. You do have to get under the bonnet and understand the companies, and in particular in kind of focused funds like our sustainable funds. We're looking for quite young and innovative companies, and the ratings agencies just don't rate them fairly because they don't have the kind of manpower to do the disclosures that they need to do. So doing that bottom-up analysis, really talking to the company, understanding the ethos behind the company, how their culture works, really does help you make decisions. But in those kind of focused strategies, you also have to be careful with your engagement, that if you have been trying to encourage something along a pathway and it's just not getting there, well, it might just be time to redeploy that capital into something that will be moving and dial shifting.
Yeah. So do you articulate that in your literature then? Is that explained? That?
Yeah.
And then for the ethical fund, is that different from the sustainable funds?
Yes, the ethical funds are very much values-based. And so, when a client buys into our ethical fund, it absolutely knows that it will not be exposed to a whole host of concerns that people may have. And we ask our clients, are these still relevant? And we do make adjustments every 2 years according to our clients' needs. So engagement in the ethical fund is really to slightly move their ESG profile upwards, because the objective of that fund is to avoid investing in things rather than proactively investing in good things. But the consequence of avoiding investing in bad things is that you will invest in good things.
Being left with great companies. Yeah.
Exactly.
Yeah. So can I come on then for a moment to the sort of way you articulate that kind of grey area between engagement or stewardship activity and stock selection? Because there's a point at which, so escalation strategies we talk about, but would someone like to have a go at kind of explaining how you convey the sort of bit in the middle where it's kind of maybe we would, maybe we wouldn't, and perhaps we should sell, let's try a bit more engagement. Would someone like to pick up on that?
Just to start, I think before, when it comes to stock selection, part of it, you have to be very clear in your ethical or beliefs-based restrictions what absolutely is not an eligible stock. Mm-hmm. So you start with ineligible because of the exposure, the industry exposure. Then, well, Megan was much more versed with this than I am, but then you have to undertake an ESG, environmental, social and governance analysis, to identify any material financial risks that are embedded in that business. And you may or may not need to adjust the price that you're willing to pay for a company. Then, once it's passed all those hurdles and it's in your portfolio, then the question is, where is that company lacking? Can you improve it on certain areas? Are there risks that are systemic as opposed to company-specific, where managers can have a role in changing the way that the system works? And for that reason, a lot of our engagement goes beyond just the companies that are held in our portfolio at any point in time, and they really tried to change the way that the system works. Move the dial.
So you'll talk with companies that are outside of the portfolios.
Yes, yeah.
Which is good. Hopefully, with a view to bringing them into the portfolios.
Sometimes, but not necessarily.
Yeah.
Part of it is because we're all aware of how powerful positive peer pressure, or peer pressure more broadly, is, and sometimes, if you want to get a company to move, actually, and they're not responsive, getting a company in the same sector or a key competitor of theirs to move ahead can be the key to getting that troubled company up in the first place.
Yeah, we all like a good bit of competition.
Or working with other investors in that company. I mean, it's unlikely that one investor in the UK will get Amazon to change their behaviour on responsible technology, but if you work with other investors, and the collective bargaining power for that is obviously much greater than one individual asset manager. So we do a lot of engagement with other companies, in particular in the area of responsible technology, and with the view that the regulation, of course, will catch up, but we're making sure that the companies we're investing are thinking ahead on that, so that in the future they don't have any financial penalties, but also do the right thing for their customers and society.
And do you communicate that differently for your essentially ethical funds versus responsible strategies?
No, everybody gets that level of engagement. The responsible and ethical strategies will have specific restrictions around the companies that they can invest in, are values-based, similar to the way Amy explained it, but everybody gets that level of engagement because, as I said earlier, these are financial risks at the end of the day. We think of ESG risk as any other risk, interest rate risk or input cost inflation risk. They make a difference to the business.
Cool. And Adam?
Yeah, collaboration is extremely important. We see it as an impact manager. We're relatively small in size, but we do have a bit of an outsized voice with a lot of the companies we engage in. So, working with other asset managers, but also NGOs as well, has a big impact. And it was interesting the point you made, Amy, as well. Because we have a very clear set of firm standards for industries that we will not invest in at all, we quite often get asked, well, okay, so what are you engaging with these companies on? And I think one of the key things that we try and focus on is, well, what are you doing as a company to take responsibility for what's happening within your sector? Can you push the dial on that and change what is going on that is not acceptable? And we're finding that's having a lot of positive impact as well. And as you said, Megan, a lot of firms understand that actually this adds value to their business as well. And again, talking and engaging with firms from the get-go will help them be better perceived in the marketplace as well. And that then attracts interest from other asset managers as well, which is good for the company, and etc. So yeah.
Yes, so, okay. I think it's really interesting. I'm wondering actually if any of you would like to give examples. Like you mentioned Amazon, but are there any other companies that you might want to talk about where you've got that kind of fine balancing act? And if you can comment on SDR, the labelling as we know it, do you think, can you give examples of what you think might fall into, an improver type situation, or a focused or an impact type situation, and again exploring that dynamic of what would tip you over into one and what would tip you over into another, perhaps. Miranda.
Yeah, apart from the fact that the ethical funds don't have a home at the moment, which is quite sad, when we're looking at our other funds in our suite, our sustainable funds will quite comfortably fit in the focus fund. 70% has got to be aligned to a certain strategy or theme or whatever. 100% of our invested assets are aligned to a sustainable definition. So it's going to absolutely fit in there. But that doesn't mean that the funds in particular will not be using their engagement to drive improvement. That's a core part of that strategy. Whereas Climate Transition Fund, it's going to be more comfortable in the improver category, where you are buying things that maybe aren't perfect at the moment, that are doing something to try and move up that transition curve, but there's a lot more engagement needing done, and a lot of that, particularly on climate, will be done through collaborative, because collaborative engagements are really designed to raise the tide, to get a huge number of companies further up, and then we'll use our individual engagement to reinforce that message.
Yeah, which I think is super important and under recognised often by intermediaries, because it doesn't tend to be communicated very well to intermediaries. You might see a name on something and that's it. But
I think certainly we'd comfortably fit into the improvers bucket. And I think part of the challenge will be to find out how and establish how we can track improvement, because it's not obvious. And what we've got to make sure we don't do is make the asks too easy, so that we can, prove that we've been influential in improving a company's approach, because that's not fair for anyone. But an example
and clients recognise it, right?
Clients,
someone who's really interested in this stuff will know that's just nonsense.
But there is a lot of amazing, shiny marketing around a lot of this stuff, and so actually we're very welcoming of these labels because they have a bit more integrity. But one of the projects where we are trying to build a framework for measuring improvement is on, and some of you will be aware of it, which is a benchmark that assesses and ranks companies on their approach to workplace mental health. And we assessed and ranked 206 of the world's largest companies this year, and comparing those scores to last year, 46 of them have improved sufficiently to move up one of the performance tiers. So for us, that is a tick in the improver, like we have proven that those companies have improved. And in the meantime, of the 206, 103 of them engaged directly with us during that year, partly because of that positive peer pressure and the new element of competition that wasn't there before.
Yeah, and it's very now, isn't it? It's very post-COVID. This is stuff that's real. Which is good. And we've added a filter option, by the way, on Fund Eco Market, so you can find your funds plus other funds that do look at workplace mental health stuff.
Amazon is one of the improvers.
Are they?
Yes.
That's interesting.
And they've been quite
It's very
responsive. But, as Megan said, as you said, that we built a $9 trillion investor coalition to support this. This is absolutely not just our work, but it is the weight of the industry behind us and coming at those companies as a cohesive voice, which is so important.
And that's why looking at the voting track record of your manager is also very important, is are they actually doing what they say they're going to do? Are they voting against CEO remuneration if it's not linked to diversity or workplace mental health or other broad societal and environmental goals as well? So I think there are proof points, but with the SDR labels becoming more cohesive, and that will definitely benefit. I think most of our funds will either be in the improvers category because we're very active in engagement, and there will be some sustainable focus we expect as well.
Cool. And I guess from your perspective, from the audience here, get to know the managers that are a bit feisty in that area, because they're the ones actually that your clients go, actually that's interesting. They may not agree with everything, they may disagree with some of it, but that's just life. But some managers, shall we say, are a bit feistier and a bit more active and a bit more shouty than others, and a good number of those are here today, shall we say. Can I see if we can invite any questions through from the audience now? I'm feeling a bit like we're chatting to each other, and we've kind of made a good start. We've still got time, so please let's try and unpick some of the stuff maybe that's bothered you about SDR, and try and see if you can think of ways perhaps that fund managers might answer those questions. I know we've got fund pickers here, we've got lots of different areas, so perhaps if we can have a mic to the gentleman over there back right, Hannah or Charlotte, please.
The oil and gas industry is responsible for petrol, fertilizers. Pharmaceuticals wouldn't exist without it. Tech companies wouldn't exist without it. Billions of lives are dependent on it. By 2050, the net zero targets still think there will be a role for fossil fuel in the economy then. As a result, is it sustainable or responsible for asset managers and asset owners to divest from that sector and leave it to other people who don't care about these issues?
I'll start. So I think you can approach that from two ways. Oil and gas is, you're absolutely right, an important feedstock into many other things, fertilizers, plastics, etc. But there are many companies that are using alternative feedstocks for things like construction, chemicals, etc. So actually that transition is presenting a lot of exciting investment opportunities. I was in Switzerland 2 days ago with a construction chemicals company who are taking recycled material and using it to be one of the building blocks of cement, and that used to be from petrochemicals essentially. So I think there are many companies where you can still have exposure to these industries without being exposed to oil and gas, but it goes back to Amy's point about values, and are your clients prepared to exclude that sector for now, which is clearly critical to the economy, or do they not want to, and would they rather be invested in those future solutions providers that maybe are earlier on their journey at the moment?
I think it's quite a balancing act at the moment. Obviously, war in Ukraine, whatever, we've had energy prices that have been rocketing, and therefore the fiduciary duty and making money, balancing over, we can't keep pumping oil out of the ground. The cold, hard reality is if we keep on doing that, your pensions are not going to be worth anything because the world will be uninhabitable. So it's a very close balancing act, and it is brave that CCLA have made that decision. But very soon, everybody's going to have to be making a similar decision because we just cannot go on in this pathway.
When do we expect to have an economy that doesn't need fossil fuels? Because I don't see anyone saying that in the 2050 targets, for example.
I mean, it's partly for that reason, and the point you made earlier, that we're not allowed to say that our funds are fossil fuel free, because the fact of the matter is the entire global economy is based on fossil fuels and products that come from it. So it's a really good point. Yes, I think it comes back to values, absolutely, and we've had a very clear call and message from the vast majority of our clients that says they don't want to be exposed. But also, us divesting isn't really going to change the way that these businesses work. So actually, we, generally speaking, try not to divest, because in the vast array of toolbox, if you look at a toolbox for change, actually the sort of divestment represents closing a toolbox and walking away. But frankly, and this again goes back to the financial risks associated with this, if we have any chance of achieving the goals of the Paris Agreement, then those fossil fuels, coal, oil and gas, are going to have to become either illegal or too expensive to extract from the ground. And so actually, if we are looking to invest for the long term, it's just not a responsible place to be parking our clients' money.
And the IEA, I think it was 2 weeks ago, said that we're at peak fossil fuel. So even the IEA expects it to come down. So it's something that's going to happen. It's a matter of when.
Yeah, that was a statement that was kind of under-recognised, wasn't it? It's quite a big deal. I mean, we've been talking about getting to this point for a really, really long time. And now hopefully we are there, and it is a really difficult one. But on the wording and explaining that kind of stuff to clients, the way we word it on fund eco market is done very carefully, which is excludes coal, oil and gas majors, because talking about fossil fuel free is really dangerous in this area, as you were saying. It's not terminology that any of us should be using with our clients, because we'll be called out for greenwash, and rightly so, because of the way the industry works. So. Are there any other questions right now? At the back there.
Hello, Stanley here. I was wondering, do you invest in organizations that have transition plans to move from oil and gas into the green energy? Because if you look at the way Africa is, for example, at the moment, if we're talking about ethical investment, the emerging market is a focus, it should be a focus for ethical investment. And they're still not even having any plans around the transition into green energy, because it's not sustainable for the economy of that continent. So do you invest in companies that has transition plans to go that way?
Yep. So who's going to say Orsted first?
I have to say for our ethical portfolios, we don't. The ethical portfolios that we run are very, very strict and exclude all kind of oil and gas exposure and anything that's damaging to the environment. But in our other funds, we absolutely do. You know, there's a great company, AES, which is moving from coal to much more renewables. And that is something that we have, bought into, and we're working with through engagement to make sure and holding their feet to the fire that they are going to stick to that.
Sorry, what was the company name again, Miranda?
AES.
EES?
AES.
AES, okay. Are there any other examples around here that people would like to
Yeah, I mean, we only have one oil and gas company on our equity buy list, which is Equinor, and they are the only one that we think have a credible net zero transition pathway that can be done profitably. So yes, we will, but the pathway has to be credible. But that would not be owned in a responsible global equity fund, but for a broad equity fund it would, because it goes back to that financial materiality point.
And can any of you comment on whether or not it's different for bond markets, or is that something any of you comment on? Or sorry, Adam, you want to come in?
No, I was just going to say we're exactly the same. So we exclude all fossil fuel and gas and oil companies. But we are financing the transition in the emerging markets in primary investment and infrastructure, off-grid, run-of-the-river hydro, etc. So it is possible to access that, but again, not supporting majors in transitioning.
Yeah, that's a really good point, because I think if you buy impact funds and you fund that through selling dirtier companies, then really all you're doing, if you're buying these things on the secondary market, is you're handing the dirty companies to somebody else, and those companies will carry on doing exactly what they've always done, and you're buying secondary market exposure to so-called impact funds. So it's really important to be trying to find opportunities in the primary or private markets where you're literally dedicating fresh capital, like fresh cash, into projects that wouldn't otherwise have happened. So we seed funded a company called the Clean Growth Fund a few years ago.
Yeah. Sorry, I was waved out earlier, so we're not all lifting our mics.
Sorry.
Did you catch that at the back? Yeah. So is that audible?
I think in the fixed income market it is different, because obviously there's a huge explosion of green and renewable bonds, and that is primary cash going in. And as long as you are sure,
and that's facilitating the transition that Stanley's talking about.
As long as you're absolutely sure that there are safety mechanisms in place that money can't leach out to do other activities that you wouldn't want them to do, then you absolutely are funding the transition through that avenue.
And that's a good point, actually, Megan, because it comes back to yourselves in this room having faith in the systems that Julia and others have built, and what we're doing as asset managers, that we're doing what we say we're doing. So actually, are we digging deeper into the issuers of bonds, or are we just looking at the ICMA framework or whatever and just saying, yes, this seems green, or we're actually making sure that the proceeds of it are being used for what they say they're doing? And again, we have an interesting standpoint on this, where if a company doesn't meet our minimum standards, but they're issuing a green bond that does, we still won't back it. We'll still say, sorry, as a company, we don't believe in what you're doing, we won't invest in you, therefore we won't back your green bond either.
So that highlights the difference between some of the strategies here, doesn't it? Because the answer is that some clients will want that. They'll just want to say, absolutely not, you don't get involved, like ethical funds, and others will be more.
But again, as we've all agreed here, as long as you're very clear as an asset manager in what it is that you're doing, what you're not doing, and how you're doing it, then hopefully that can provide reassurance to the people in this room and then the ultimate clients as well. And I think the SDR labelling will hopefully link into that as well. So it's transparency at the end of the day.
Absolutely. Miranda?
No, we're exactly the same. If a company does not meet the minimum standards that we set, we will not invest in their green bonds.
Cool. And do you take that position as well, Saracen CCLA?
We look at the green bonds on a case-by-case basis, so look at the prospectus. As you say, it's very important to read the fine print when you're looking at a green bond. But I think, and the majority of these are in, like banks, for example, are a big issuer of green bonds at the moment, and they may still have fossil fuel lending operations, but they may be issuing green bonds to lower the cost of capital for green and renewable projects. And we think that's a great thing, if we can bring down the cost of capital for building the solutions to net zero, then we wouldn't exclude a company on that basis.
And this is kind of what the point of panels like this are about, that there are different views, right? And your clients will have different opinions too.
But just to be controversial as part of a bank, which I think is, I agree with exactly what you're saying, So we don't invest in any financials that don't meet the Global Alliance for Banking on Values framework, based on the fact that as a business, yes, they probably do have a decent score in ESG terms, and the bonds might stand up. But when you look at the loan book and what they're financing, they're having such a negative impact. It's absolutely unbelievable. So again, for us, hard line, financials, no.
It depends on the bank, though. If it's a regional bank or a building society, it's totally different to, Barclays.
Yep. So again,
the loan books are different. I think it's important to do that work and to understand the institution and not just blanket catch-all.
That was probably a bit glib of me to say that, but you're absolutely right. So again, it comes back down to digging in and knowing who the organisation is, what they're looking to do. Absolutely.
And what the embedded climate risk is to their loan book as well, particularly if it's to companies or people who are at high risk of climate change. I mean, in insurance, for sure, you're seeing this in the US now with some of the larger insurers moving out of particular states because actually they think they can't price that risk. So it's the same with the banks as well. Are they embedding that risk into their loans? So it's another thing to consider.
All I was going to say, this is maybe slightly controversial, but this discussion that we've just had about applying the same standards for a company's equity as to their bonds raises a question about how the people in this room should be selecting their funds. So are we going to be just investing in a fund, like a clean fund, even if the investor as a firm has what might otherwise be termed as socially irresponsible funds? Or should we be looking at the firm, and I know the FCA acknowledges the importance of this as well, but should we be looking at the entity level more than just fund by fund?
Yep. And that's right, it's really important that both dynamics come through. Can I ask you each then for just final thoughts on this, just give a tip for advisors and people who are selecting funds in this area, maybe just sort of 20 seconds each, please, if right. Miranda, would you like to start?
I think just talking to us. The same way that we have to understand companies, bottom-up analysis. Please just come and talk to us. Ask us about our funds. If we've not said something clear enough, please just tell us, and we'll fix that.
Well, I say, if you're unsure whether a stewardship team is actually doing the improver work well enough, I'd say it's really important that a team is well-resourced and that it has the ability to be, persistent, logical, creative to an extent, and actually has the ability to build very meaningful and long-term relationships with the companies that they're investing in.
Yeah, I think that's a really important point, and I would just add, if you're selecting a manager for their ESG credentials, ask for the proof points, look for the voting record, look at the portfolios, look at how they are pricing ESG risk when they think about the fair value of the companies and bonds that they're investing in.
I think you've covered it all pretty well, all three of you. I'd agree completely. Yeah, just speak to us and ask. Yeah.
I agree with Nick.
Thank you. I didn't think there'd be time for this, but great. This conversation is about dial shifting. How do we move the dial? It seems to me that in a secondary market, investment selection and divestment, while necessary, won't necessarily shift the dial, but engagement stands the best chance, particularly if we're looking to transition companies and transition the economy. Particularly collaborative engagement as well, I imagine. Engagement's expensive, takes time, takes research. How much should you guys be spending on it as a percentage of your revenue or profit? How would we know?
Does anything matter more to the business than its future survival? I think might be the answer. But that'd be my answer.
So how do we differentiate?
It's a really good question. I think the FCA is undergoing a sort of working group as to how we should be resourcing stewardship as an industry, how much we should be spending and what percentage. I think that's underway. All I would say is that for our company, our sustainability team is 11 people, and we manage £14 billion. So that team is enormous compared to the money that we manage. And about sort of, let's say 50% of that team is active stewardship professionals. And we we run various different coalitions, and combined, we now have 103 institutional investors signed up to CCLA's sustainability initiatives, representing £17 trillion pounds in assets under management across 15 countries. So as you say, the collaboration is really important, but it's not easy, and it takes a lot of people and a lot of effort and a lot of time.
I think we're going to have to close there in the interest of sticking to the agenda, but thank you, that's a really good question, and that is something that really needs exploring, isn't it? Can I just add in one extra thing, which is when I went to Reset Connect in the summer, Duncan's big event that he organises, one of the speakers there was talking about a sell-off of 4% of oil and gas company shares would be enough to trigger a collapse, and that was some senior policy advisor to government, etc. So I wouldn't underestimate not only the interest of clients have in just avoiding stuff, but also, you know, the potential impact, because once you see a drop in the shares, clearly change will start to happen because they'll be fighting for their survival. So I certainly would not write off exclusion in this area, and I'm talking far too much again, so I'm going to close and ask you to thank the panel in the usual way.